All right, so today we're going to be talking about the loan estimate and how to read the loan estimate. The loan estimate for your regular loan originator is going to be very easy to understand, but if you're a realtor, it may not be as easy to understand, and if you're a borrower, it probably won't be easy to understand at all. So what I'm going to do today is try and just simplify the process. I'll go over the first 2 pages of the loan estimate. Those are really the most important. Third page doesn't have much on there that you'll really care about, but I'm going to go through the first 2 pages. And I'm going to present it like I was talking to a borrower, because we go over the loan estimates with our borrowers every single time and make sure that they understand the settlement fees, what the payment's going to be, what the payment's comprised of, how we get paid on the loan, etc. So I'm going to share my screen and let's see here. We'll get the loan estimate up. Okay. So this is your standard normal form loan estimate. It's broken down into some pretty easy to understand pieces. So in the top up here, the top, I would say, quarter of the page, it's going to be your standard stuff. So the date it was issued. So the date this one was issued was September 26th. The applicant, so that should have your name, your address, and then the property that you're buying, and what the sales price is. So you could see up here, this purchase price for this home is $620. And then in the upper right-hand corner, the loan term is for 30 years. It's a purchase loan. It's not a refinance. The product is fixed rate, so you don't have to worry about an adjustable or anything like that. This loan is conventional. You can see where it's marked. There's a loan ID that's specific to your loan. And then the rate is locked. So this is very important. You can see here that this rate is locked. If it was not, obviously the no would be checked. But then this is kind of an interesting part. So below that, it says, before closing, your interest rate, points, lender credits can change unless you lock the interest rate. All other estimated closing costs expire October 7th, 2022. So it's going to be 10 days from the day that this is delivered to the borrower, and that's the settlement fees. But when the loan is submitted, those settlement fees, if we know who the settlement fee company is, those are subject to some specific tolerances, and I'm going to go over those in a second. So top third, loan terms, big black box there. Loan amount is $496,000. And it says, can this amount increase after closing? And the answer is no. So this might be kind of an interesting question. If you've never seen this before, or if this is one of your most recent purchases or even a refinance, and you weren't around during, say, the 2005 mortgage period, this doesn't really make any sense to you. So believe it or not, back in the day, so 2005, 2004, we were doing loans for people that had payments that would allow you to make a less than interest payment. So when you were making a payment on your mortgage balance was actually increasing every single month. And so when the crash happened in 2008, the regulator said, look, you have to inform the borrower that if they're going to make a payment and their loan balance is going to increase, you have to inform them of that. Because a lot of people, they were taken advantage of, and they didn't know that their payments were going to increase. So the loan amount here is $496. And again, it cannot increase after closing. The reason why is because it's a 30-year fixed rate conventional loan. Every payment that you make is going to reduce the principal balance. The interest rate is 6.125. Rates have gone up a lot since December of last year. We were doing loans at 2 3/4 that period of time. Now we're 6 1/8. So rates have definitely gone up. And it says, can this amount increase after closing? The answer to that is no. So why is that important to you? Well, it's not an adjustable rate mortgage. So that rate is fixed for the entirety of the term of the loan. Monthly principal and interest payment, $3,013.75. Again, this cannot increase after closing. And the reason why is because it's a fixed rate loan for 30 years. And so that payment is going to remain the same. Below that, it says prepayment penalty. The answer is no. So you can fully or partially prepay this principal balance, and you won't have any penalty. So again, back in the day, there were loans that carried prepayment penalties. Those loans, typically it was 80% of the principal balance, and they would charge you 6 months of interest on that amount. If it was paid off, usually they were 3-year prepays. So this doesn't have them, and really no owner-occupied loan has prepayment penalties anymore. They changed the law, and you can't do that. Balloon payment, the answer to this, does this loan have any of these features? The answer is no. And a balloon payment, if you don't know, it's a 30-year loan, but it's due in, say, 10 years. So that's one large balloon payment that's due prior to that 30-year term. That would be a balloon payment. So it's due and payable in 10 years, not 30 years. Even though the payment may be amortized over 30, there's a payment that's due for the full amount at a certain period of time. We don't really have those loans anymore, especially on primary residences. So the answer to that question is no. And then in the middle of the page here, so projected payments. So you could see principal and interest payment years 1 to 30. Again, it's fully amortized fixed rate loan. So every payment you make for the entire term of the loan is going to be $3,013.75. There's no mortgage insurance premium, as you can see here, because you've got a greater than 20% down payment. And then below that, it says estimated escrow. And I am right here on this page or this portion, 746. So this is an interesting thing. It says this amount can increase over time. And people say, hey, if I'm in a 30-year fixed rate mortgage, why is my payment going to increase over time, or why can it increase over time? Well, the answer to that is pretty simple. If the property tax collector in your county raises your property taxes because of bond measures that are passed or whatever, then your property tax will increase. And as a result, your estimated escrow payment will increase as well. If your homeowner's insurance company increases your insurance premium, or if you choose to take a larger insurance premium because you want more insurance, then that too will increase. So just know that if you see an estimated escrow portion like this and it says that it can increase over time, it's not the lender that's changing your payment. It's something that's outside of their control and outside of your control for the most part. And so that can increase over time. Doesn't mean it's going to, probably will, but it can increase. And so we need to disclose that to you. So your total monthly payment is $3,760. So that's the principal and interest payment plus the estimated escrow. And then below that, again, it talks about the estimated taxes, insurance, and assessments. So if there was a homeowners association, that would be this other section here would be clicked, and it would say, is this in escrow? And the answer would be no below that. So this section here talks about whether or not you have property tax, homeowners association dues. So here again, it's $746 a month. That includes the property tax and the homeowner's insurance. And it says, is this in escrow, which means is it included in the monthly payment? And the answer is yes. So that's what comprises a portion of that $3,760 payment that you see up there. So that's the middle section. And then the bottom, costs at closing. So this is one of the more important things other than the payment, obviously, are the estimated closing costs. So the total closing costs here are $21,664. Now, beside that, it breaks it down in detail. So it includes $11,919 in loan costs plus $9,745 in other costs. And there aren't any lender credits on this loan. And then it says see page 2 for details. So I am going to jump to page 2 and then come back to page 1. So remember, it's $21,664 in total costs, and then it's $11,919 and $97.45. So where do we find those numbers? Well, we find them on page 2. So you could see that section A, B, and C, they're summed up down here in D. So you could see D says $11,919, and that's A, B, and C. Okay. Now, if you go back to page 1, you'll see that that's in this portion. And then it has $9,745 in other costs. Those are sections E right here, F, G, and H. And then those are totaled up in I. So and there's your $9,745. So you can see where the costs are broken down. It's all on page 2. So the first portion of those closing costs are going to be on the left-hand side, and the second portion is going to be on the right-hand side. And then it says estimated cash to close. So 143,326. That includes your closing costs. And again, it says see calculating cash to close on page 2. Calculating cash to close on page 2 is going to be located down here in the lower right-hand portion. It's going to have all the numbers put together. So I'll start with section A. So this is your origination fee. So on a loan estimate, there are certain fees that have a zero tolerance, which means that when we disclose to you these fees on your loan estimate, they can't increase unless there's been a change in circumstance that is allowed, right? And I'm not going to get into what those might be, but section A has a zero tolerance. That means that what I disclosed to you today cannot be increased. And there was a trick that some loan officers would play back in the day where they would inaccurately, whether it be innocent or on purpose, would inaccurately disclose to you what your fees were. And then you would get to the closing table and your fees would be increased by $10,000 or $20,000. And at that point, it's too late, right? You're kind of locked in and you're stuck with that product. I mean, your option is to back out and maybe lose your earnest money deposit. And so they said, look, you can't do that. This is a zero tolerance item. Section E, taxes and government fees. That's also a zero tolerance. So for instance, if we don't disclose a transfer tax that's due by you that you have to pay as a buyer, if we don't disclose that to you, and at the end there's a transfer tax added, we have to pay that as the loan originator. It would come out of our compensation. It's called a broker cure or a lender cure. So we would be paying that on your behalf because we misrepresented the fees. Section B, services that you cannot shop for. This has a 10% tolerance cure. So the fees that I disclosed to you today, the maximum that they can increase is 10% above what we've disclosed. Again, unless there's a valid change in circumstance. And then section C, that too has a 10% tolerance cure. And then F, G, and H, there's no tolerance cure on those. And those are just typically property charges and then your optional owner's title. So we'll go through these. So section A, again, zero tolerance. Total of all fees, $6,938. It's all of these fees here combined. So there's a, and I chose this loan estimate for this presentation because it'll give you an idea of how to read the different origination fees that are going to be included in the loan estimate. So 0.187 of the loan amount. So this is discount. What discount is that's what you pay to reduce your interest rate. So the cost for this was 0.187% points for $928. Broker compensation. So if I'm charging anything, how I get paid, that too is broken down in section A. So there's two ways that we get paid in this industry. One is by charging the borrower directly, and the other is by getting paid from the lender directly. It's against the law for us to charge you money and get compensated from the lender. You cannot get compensated from two separate sources, meaning the borrower and the lender. It's one or the other. So typically, if the borrower is going to compensate us, you get a lower interest rate. And that comes into deciding whether or not it's worth paying any upfront expense to lower the rate, depending on what your long-term goals are. So broker compensation on this loan is $4,960. And then you could see there's an underwriting fee. Sometimes it's called a lender fee. That too is included in this section. That's $1,050. Section B, services that you cannot shop for. So there's different services that are required to close your loan. For instance, an appraisal and a credit report. You can't choose the company that provides the appraisal, and you can't choose the company that does the credit report, amongst some other things. So these are services that are required that you can't shop for. So in this one, there's an appraisal fee, a credit report, flood determination, life of loan, processing, etc. So these fees that are in here, and really any fee for that matter, we can't juice up. We can't add anything to them. So these are the invoice cost of the fee. So these typically in section B are going to be very similar regardless of the lender that you choose, because they're all, within about the same range. Like the credit reporting fee, that it's probably going to be $40 on this loan, not 100. But remember, there's a 10% tolerance cure. So if we under disclose a credit report fee and we have to do some things maybe to clean up the credit and we don't disclose that up front, then we can't get reimbursed for that. And so a lot of the times we'll overestimate what those fees are in section B and C, just to make sure that we have a padding in there. Section C, these are services that you can shop for. So this is always going to be your title and your escrow fee. And then any other ancillary items that have to do with the settlement, like notary fees. There might be a tax cert fee like there is here. So these fees, you can pick the title company that you want to use. You're not forced to take any one particular title company. Now, having said that, typically your realtor is going to have a relationship with a title company that they work with. And usually it's a recommended practice to go with that title officer. There are differences in quality of title companies, believe it or not. And to be able to have somebody that does their job well is a very important part of the process, and it's part of the team. Some sellers want you to go with a title company that they've chosen. There's some restrictions on whether or not they could force you to do that. Of course, you have to check with your state's regulations, but if you're a buyer and they want to go with a specific title company and you want your offer accepted, usually you're going to go with whoever they want you to use. And it's not like they're going to do anything that's underhanded. It's just that they've got maybe an open order already and they've got some title issues that they straightened out. And so it may save you some time and expense down the road. So you could see that they're totaled up in section D. So it's $11,919 in section A, B, and C. And remember, if we go back to the first page of the loan estimate, that's going to be included in the total of all closing costs. And that's right here in this $11,919 section. All right, so section E, other costs. We're in the upper right-hand corner now. So remember, this is zero tolerance area. So typically, we'll go ahead and ask for a settlement fee quote from whoever the escrow company is that's going to be handling the transaction so that we can know what those closing costs are for this section. So taxes and other government fees, small recording fee of $91, no transfer tax due by the borrower on this specific transaction. And then section F. So these are prepaid items. So 9 times out of 10, the homeowner's insurance company is going to require that you pay that first year's homeowner's insurance premium up front. And so we're estimating that that's going to be about $1,200. If it's less, then this amount will obviously be less, right? Because we can't charge you more than what the actual fee is. So it's up to you who you want your insurance company to be. And then you have prepaid interest. So the prepaid interest on this loan is for 12 days at the 6.125% rate. It's $1,013. So if you don't know, and sometimes people don't, so if you're renting right now, the rent that you pay, so this loan estimate was given in September. So let's use October 1st. So when you pay your rent October 1st, that pays for that month's rent. It pays for the month of October. Well, for a mortgage, you pay in arrears. So your October interest due would be paid November 1st, right? So if we're going to close this loan, say October 18th or 19th, your first payment isn't going to be due until December 1st. And that December 1st payment is going to pay for the month of November, right? Well, if we close at the end of October, you've got a number of days of interest for the remaining portion of the month that has to get collected, right? Because your December 1st payment is going to pay for November, but you're going to move into the house in October. And so they collect interest for whatever the remaining days are in the month from when we close. So if we closed on the second day of the month, they may be collecting 29 days of interest, depending on how many days there are in that month. So sometimes it's more advantageous for you to close towards the end of the month because you're going to pay less interest. It's going to save you some money. Now, you're going to have to make a payment sooner. So it's kind of 6 in one hand, half a dozen in the other, but it's a way to plan. And then your property tax. So for this state that this loan is closing in, there's 6 months of property tax that are getting collected, $3,875. And this would bring up a question. So if you're getting charged 6 months of interest, but you're only living in the home for, say, 2.5 months, why is it that you have to pay this 6 months of property tax? Well, the title company is going to collect for that. But if you look towards the bottom, so you could see this adjustments and other credits section at the very bottom, 2338. So that's a proration from the seller to the buyer for the period of time that the seller owned the home. Okay, for that second installment or first installment in this particular circumstance. So just be aware that you will have some offsetting credits to some charges. So your net expense as the buyer on this would be about $1,500. And then section G. So this is initial escrow payment at closing. Again, if you didn't have an escrow payment, you didn't have your taxes and insurance impounded in the payment, this would not be required. So you could see here that the homeowner's insurance is $100 a month. It's collected for 3 months. So anytime you do a purchase, you're always going to have 3 months of homeowners insurance that's going to be collected. And then the property tax, depending on your state and the month that you close in, that's going to determine how much property taxes are collected. And in this state, this was California loan, they're going to collect for 4 months of property tax at the $645.83 per month. For $2,583. And so that makes up the total in section G. And then H is a optional owner's title insurance policy. If you were purchasing a home warranty, that would be in this section as well. And why does it say optional here? Well, the reason it says optional is because it's not something that's required for you to purchase. You don't have to have an owner's title policy. Now, if you look in section C, you have a lender's title policy. So anytime you borrow money on a home, that lender is going to require that you pay a title policy, and it's in their favor. It's not in your favor. So an owner's title policy is a good insurance against something that maybe the title company may have missed. It's a very inexpensive insurance policy. You could see it's $683 adding to the settlement fees for a home that's costing over $600K. So again, it's optional. It's not forced, but I always recommend that people do purchase owner's title policy. It's going to give you some peace of mind. And then you could see that all the costs are covered here. So section I, that's all the costs in E, F, G, and H. Again, it's $97.45. That was on the first page in that closing cost section. And then J is the total of D, which is the bottom left-hand corner here, and I, right? So it makes up that. So that's $21,664. And then you could see your total cash to close. This is how it's calculated. You have your closing costs of $21,664. You have your down payment funds from the borrower, 124, and then you subtract that seller's proration for the property tax, and your estimated cash to close is $146,326. So you could see if you go through this systematically, it's relatively straightforward. As loan originators, we the only things that we really have control over is the compensation section in section A. Other than that, whether you use my company or somebody else's company, you're going to have an appraisal fee, a credit report. You're going to have section C. Those title fees and escrow fees are going to be the same whether you use lender A or lender B. Same with section E, F, and G. Those are prepaids. That's homeowners insurance, prepaid interest, property taxes, recording fees. Those are not governed or determined by the lender that you choose. And so as a mortgage broker, our job is to shop a loan for you and get you the best priced loan that meets your needs and gets you with more than likely the quickest closing, right? Most people don't want a long-term time. Some lenders that might be very, very inexpensive, everybody knows that they're inexpensive and they may be really backed up. And right now, volume is reduced. And so there's not a tremendous amount of that happening, not like it was last year. But if you need to close in 15 days, which we do often, not every lender can do that. And so we need to make sure that we select a lender that's going to provide you not only the best rate, the best ongoing service after closing, but also the quickest turn times and ease of use for you as a customer as well. So hopefully that makes the loan estimate a little bit easier. We'll probably do something on closing disclosures eventually. They look very similar to the loan estimate. And really, the only difference with the closing disclosure compared to the loan estimate is that once the closing disclosure is issued, those fees can't change. Most certainly can't increase. So that's like the final accounting is the CD or the closing disclosure. And it'll say closing disclosure instead of loan estimate on the top. So maybe might not review that, but like an estimated settlement statement, that might be something good that we can look at. But hopefully you learned something. My name is Jesse Gonzalez. Look forward to speaking with you. If you have any questions, hit me up. Happy to help you anytime. And again, I appreciate your time and tuning in. Thanks. Talk to you soon.